Jeremy Grantham discusses three key points regarding the current state of the financial markets. Firstly, he mentions that the bond market is extremely overpriced and interest rates are at historically low levels. This has resulted in a negative return on investment, where investors are essentially paying the government to hold their money. Grantham highlights that this is unprecedented and has never been seen before. The second point he raises is regarding the U.S. equity market, which he believes is one of the most expensive in history. He states that experts in the field of economic bubbles generally agree that it is even more overvalued than the market was in 2000, which was considered an epic bubble. However, Grantham acknowledges that there are some who may not share this view. Nevertheless, he emphasizes that most experts recognize the high valuation of the market. Grantham focuses on the real estate market as his third area of concern. He reveals that in recent times, real estate has experienced a significant increase in value. According to certain databases, prices have risen by 20% in the past 12 months. He compares this surge to previous instances of inflation and housing bubbles, stating that the current spike is the sharpest rise ever recorded. Grantham then highlights the metric used to measure affordability, the multiple of family income. In the past, a home in America would typically sell for 3 times the median family income. During the housing bubble in the mid-2000s, this number increased to around 4.5 times. Grantham argues that currently, prices have reached this same level, indicating a potential bubble. Grantham explains that low interest rates make it appear affordable to buy these assets. However, he notes that the problem lies in the initial purchase itself. Asset prices have risen to such high levels that it becomes increasingly difficult for beginners to enter the market. Grantham believes that this disparity between asset prices and income levels is detrimental to society as a whole, as it significantly slows down wealth creation. He demonstrates this through a simple arithmetic example, explaining that with lower yielding assets and higher prices, it takes much longer to accumulate wealth. As a result, individuals who do not already possess assets, and society in general, suffer greatly. Furthermore, Grantham highlights that this disparity is not limited to housing, but also applies to stocks. He argues that the value of stocks is driven by a narrative that allows investors to believe that their earnings have skyrocketed, even though there may not have been a significant change in long-term earning power. He emphasizes that this illusion is what makes stock market bubbles so dangerous. Grantham highlights that a unique situation is unfolding in the American economy, where the real estate market, bond market, and stock market are all experiencing tumultuous conditions simultaneously. Furthermore, he mentions that the commodities market, particularly non-energy commodities, is also showing signs of instability. While the Goldman Sachs index for non-energy commodities is heavily influenced by oil prices, the non-energy portion, which includes metals, essential food items, and cotton, has reached its highest level since 2011. Grantham also draws attention to the UN Global Index of Food Prices, which is approaching its 2011 peak. Addressing the energy market, Grantham describes fossil fuels as being in the end game. He notes that the stock market, primarily focused on the United States, remains generally unaffected by these developments. Although developed countries are considered overpriced, countries like the UK and Japan are exceptions, while emerging markets appear to be ordinary. Grantham suggests that, compared to the U.S. market bubble, emerging markets currently offer favorable investment opportunities with historically low points. He exemplifies this by discussing how, in 2008, emerging markets had a price-to-earnings (PE) premium over the S&P, whereas now they are selling at a significant discount. Grantham acknowledges that the current situation appears very different from previous market conditions. He struggles to find many similarities. Nevertheless, he believes it is crucial to analyze the price to do. In the spring of last year, the stock market experienced an interesting phenomenon. It became cheaper than it was in the aftermath of the 2009 crash. However, the U.S. market saw a significant increase in price, going from 11 times earnings to 22, while emerging markets decreased from 11 to 10 times earnings. This divergence indicated a preference for the U.S. market, which is usually a positive sign. This situation required investors to pay attention and be ready to take some risks, as the probability of emerging markets outperforming the US in the next 5 or 10 years seemed very slim. When it comes to measuring the strength of an economy, it is important to consider factors such as the ability to outgrow other countries, improve the living standards of the population, and provide access to education. China and India have been able to achieve these goals, making them strong economies in this regard. The success of these countries, especially China, in educating their workforce should be a cause for concern for others. Chinese workers have achieved higher scores in math compared to their counterparts in the US, making them not only more affordable but also more skilled in basic quantitative methods. This realization has made many people, including those in Silicon Valley, nervous. However, one can argue that countries without highly functioning democracies may face long-term constraints on their prospects. Capitalism has proven to be an effective economic system in many ways, but it is ill-suited for addressing long-term issues. The discount rate problem associated with capitalism means that anything that happens more than 20 years in the future tends to be overlooked, whereas Chinese society is better equipped to address long-term problems like climate change and population concerns. They respond to these issues more quickly and seriously, and have a greater respect for science. The biggest risk to American business and society is the increasing concentration of corporate power in politics and monopolies, which leaves workers and unions at a disadvantage. The US also faces income inequality, ranking last among 20 economically developed countries. In addition, social mobility, once considered a hallmark of American society, is now more difficult. This suppression of the ordinary worker poses a long-term threat to the country's capitalist society. Since 1970, average hourly wages in the US, adjusted for inflation, have remained stagnant, while other countries have seen significant increases. France, for example, has experienced a 140% wage increase, while the US has seen no change. This has led to discontent among workers and can be attributed to the dominance of corporatism, where industry insiders are appointed to regulate sectors they are connected to, allowing corporations to gain more power over regulatory bodies that should protect the public from their misconduct. Societies tend to go through cycles of moving towards capitalism and then back towards worker-focused policies. The Gilded Age of the late 19th century was a time dominated by capitalism, but subsequent events, such as wars and the Great Depression, led to a shift towards worker empowerment from 1945 to 1975. During this period, productivity increased, pension funds were established, and educational standards for the general population improved. However, since 1975, corporate power has steadily increased, leading to greater income inequality and less support for workers. As new technologies emerge, they often benefit the elite and technologically gifted, resulting in the rise of corporations worth billions in just a few years. Unfortunately, these developments seem largely disconnected from the average worker. Overall, these trends and shifts in economies and societies call for careful evaluation and action to address the challenges posed by corporate power, income inequality, and the need for long-term planning in areas such as climate change and population.